Welcome to TheoTrade. This is Don Kaufman. It's April 23rd, 2018. You are watching the Theo Night video. Let's get started with the S&P futures, which saw some, well, fairly wild volatility once again early on in the week. Again, this might not look like much in the chart, but we traded directly up to the 2682 level. For those of you unaware, we've been talking about the 2682 as one of what we term our gravity points for quite some time. Literally touched into the 82 level, saw some pretty heavy sell side activity all the way down to 2657 before bouncing back up. And we're pretty close to finishing today's trading session massively unchanged. One of the surprising things though inside of today's trade, especially on an intraday basis, and this is one that's got me kind of scratching my head, the volatility never really picked up that much, whether you're looking at the volatility futures, whether you're looking at the VIX. There was a point in time today where we saw some pretty heavy sell side activity. Nevertheless, we did not see, the market volatility itself start to pick up. Now, one of the things that is going to come into kind of a center stage this week is none other than earnings, which is going to be kicked off this evening. Again, earnings season's already in full swing, but this evening kind of kicks off the monsters of tech in terms of earnings. And I thought I would take you a little bit through some of the trades on Google. Now, by the time, of course, you watch this, Google's earnings will have already been released. Nevertheless, we've got, the likes of, well, all your major tech stocks are pretty much releasing this week, next week, whether it's Facebook, whether it's Apple, Netflix already released, and Microsoft and Amazon. Oh my, again, it's a week packed full of earnings announcements. And all I wanted to do was take a few minutes on this evening's video and walk you through a couple of different trade ideas for the earnings announcement. And one of the first things we're going to do is we're going to open up Google. And I prefer to trade Google L instead of Goog. The reason being the option volume, is substantially higher if you take a look at Google L versus, again, just Goog. And yes, there are two independent symbols all under the mother company of the alphabet. Nevertheless, I prefer Google L in terms of a trading vehicle. So I've mentioned this a number of times regarding earnings, but what can you really do around an earnings announcement? And again, I'm going to use Google as our example. Then we're actually going to watch it, release its earnings here in just a few minutes after the bell. For the most part, you can create bullish trades, you can create bearish trades, you can do what we call neutral. But you could be neutral, a term long or neutral short. And I'm going to describe, again, one of each of these kind of biases when I actually take you through a couple of earnings trades. A lot of people, they have tendency to look at the volatility. They're like, oh, look at the volatility inside of Google. It's all puffed up. So the volatility in here is about 55%. It's neither here nor there. The volatility equates to an expected move of about, let's just call it $54. Now, how do you actually derive the $54? Like, how is that really derived on thinkorswim? Well, it uses an average implied volatility model. For those of you that speak geek, they take the implied volatilities of a ton of out-of-the-money options, they average them together, and for the most part, it helps derive the expected move. I guess the cheating methodology of deriving expected move, here, look, just add the call to the put. Work good enough? It works good enough for me. Just, the at-the-money call plus the at-the-money put, which is the at-the-money straddle. The straddle is almost equivalent to the expected move. But here's the irony of that. The irony of that is that the expected move, it means that about 68% of occurrences are supposed to happen inside of this range. But that's a pretty hefty range. I know, even on a $1,000 product. But if this is a $1,000 product, it means it's supposed to basically move up 53 or, for instance, down 53. And it's supposed to stay in that range about 68% of the time. But that's between now, and the end of 4 days from now. So let's quantify and clarify that, right? So we can build all kinds of different trades on there. First of all, could you just buy the at-the-money options? Like, could I go out and I just say like, hey, I'm thinking we're going to move big. Can I just buy the at-the-money options? You can, but you got $54 at risk. And you're going to need a move that I'm telling you right now, if you look at this statistically and you look at thousands and thousands and thousands of occurrences, you're not going to make money about 32% of the time. It's how much money are you going to make that 32% of the time that makes the difference, right? So here they are. Here's a couple of trades that I have built, okay? Good, bad, or indifferent. And as I'm doing this now, it's very likely that we're going to see earnings come out on Google. I tried to time this almost perfectly into the close today. And again, the marketplace saw a degree of volatility. We're going to end up massively unchanged, but that's probably because people are a little nervous of Google. So let me take you through and walk you through these 4 trades. First of all, okay, I create a very simplistic bullish trade. Now, the bullish trade is just a 1075, 1077 half call spread. It's done for $1.25 debit. Okay, this is one of the most straightforward, of what I would term your binary trades. It's just simply a call spread, and it risks $1.25 to be able to make $1.25. That's it, right? I don't want to extend myself. I mean, how much risk do you really want to extend yourself into on a $1,075 product when its earnings are due any second here, right? And again, I don't really feel like extending myself all that much risk, so I'm doing what's called a binary trade. It's like a coin flip, right? Risk $1.25 to be able to make $1.25. That would be your bullish scenario. Your bearish scenario is the exact and opposite. It's an opposing trade, and that actually breaks down, to a 1077 half, 1075 put spread. And again, I'd be buying these spreads. And immediately people say, well, why don't you go out and sell the spread? Well, you sell the spread or buy the spread. In effect, it's tying up the exact same amount of capital. From a margin standpoint, it's identical. One of the reasons, though, that I do not often talk about selling the spread when you initiate the trade is there is the possibility that the puts could go deep in the money or the calls could go deep in the money, and there could be an early assignment. Now, not that there would be any additional risk, because this happens to, in effect, be a spread. It would not, again, exacerbate any of the risk. I prefer to be on the buy side of this. That also has to do with the fact that from time to time, you'll even come across trades with dividends. Again, we're waiting on Google's numbers over here, No pressure whatsoever on that front, but we're going to continue to kind of build a few trades. So we looked at a bullish trade, we looked at a bearish trade. The next trade, this is your neutral trade. This is your neutral short, All this in effect does is plays around the idea of our expected move. Remember, the expected move happens to be right around $53, $54. So in effect, what I've done is I've just gone out of the money. Google is sitting right at about 1075. So let's kind of mark it up here a little bit of what this spread breaks down to. So Google is right here, right in that kind of 1075 region. And I just went up about $55 and down about $55, and I just built an iron condor. Now, the iron condor is done for a $2 credit. This is selling premium, $2 credit. How much risk do you take? Well, it's a $5 wide call spread, a $5 wide put spread. To get a $2 credit, you've got basically $3 of risk. That's it. Not much to think about on that front. Clearly, Google's earnings are out. We are on the move right now. Last, but definitely not least, we have, the neutral long shot. What is the neutral long shot? Well, let me show you. It's the inverse of the iron condor. It's looking for a move. Again, it's looking for a move that is going to take the marketplace outside of what was expected. This is where I was saying there's a neutral long trade and a neutral short trade, The neutral long trade says I want us to move more than $55. And the way to kind of script this out to you is if you were looking at a distribution curve, right? And here's your expected move. These lines are your expected move. You want to move outside of what's expected on the neutral, again, long trade. When it comes down to it with earnings, and blank the screen for a second, when it comes down to it with earnings, again, people will tell you, well, you take advantage of the implied volatility, take advantage of this, take advantage of that. People, it's all factored in. In effect, what you can do is just one of these 4 trades. Sure, you can build different types of calendar spreads, okay, and you can get a little wild with this till your heart's content. But in effect, it still all breaks down to you're getting bullish, you're getting bearish, you're getting neutral and hoping we stay in a range, or you're getting neutral and hope we smoke that range out there. Now, let's take a quick glance over at Google. Okay, I'll even bring it up on a chart. Here we go. This happens to be, in effect, on an intraday basis. Google's earnings are out. Do I have any idea what they are? Absolutely not. Okay, haven't even glanced at any of the reports. But Google closed right around that 1075. It's trading in and around right now, 1100. So we are well within the means of what was expected. Right now, we're only sitting at about half of the expected move, maybe a $20, $25, close to a $30 expected move. However, the evening, of course, is young, but it looks like, okay, in this, and again, case in point, it looks like both the bullish trade is going to work and selling premium is going to work. I want to thank everybody for joining us here on TheoTrade. And each of these scenarios can be used throughout the course of this week, whether you might want to trade Facebook or Apple, maybe Microsoft as the week progresses. These are the types of strategies that would be your go-to around earnings announcements. Have a great evening, everybody. Bye-bye.